Today, thank you for joining. My name is Daniel Evans, financial advisor here at Bogart Wealth. Today, we're going to be talking about cash flow planning and withdrawal strategies, primarily for retirement. For those of you who may not be or who might be new to our firm, our mission is to help clients achieve financial peace of mind by preserving and maximizing intergenerational wealth. As a little bit of a background on us, we have over $2.6 billion in assets under management, working with just under 1,300 households. We are a registered investment advisor, which means we are an independent fiduciary advisor working in your best interests. We custody our assets through Charles Schwab for your protection. We're a fee-only wealth management firm. Let me change my slide here. Bogart Wealth has financial advisors located in both McLean and Houston. McLean's in McLean, Virginia. We work with clients in numerous states across the country. When I do want to highlight James Bogart here, he has done a phenomenal job of growing the resources and capabilities as a firm. When you do engage with Bogart Wealth, you do have a dedicated advisor, but we also work collectively behind the scenes. We have a full operations and financial planning team in our Virginia and Texas offices. These are the folks that we may not engage with on an everyday basis, but they're the ones that make things go. We manage our investments in-house. Alex Spencer leads our investment team as our chief investment advisor or officer. We have 3 offices, our headquarters in McLean, Virginia. We have an office here in the Houston, Gessner area. And then, I'm located here in the Woodlands, Texas. For those of you who work with us, planning is at the heart of what we do. Most people think that planning for retirement is just about the investment management piece of it, but everybody's situation is different, and it is important for us to focus on your goals and manage the issues that are most important to you. If you are new to Bogart and have not gone through our planning process, I encourage you to reach out to your advisor or myself, and we can talk specifically about what you and your family are working towards. Now we'll get started. Again, today's conversation we're going to highlight here on the cash flow and withdrawal strategies. Today's topic is also part of a retirement readiness series, as we kind of highlight a lot of the planning important topics that we plan for as we get ready in preparation for retirement. This is today's overview. We're going to look at risks in retirement and how planning can help address those risks. We're going to look at retirement income and the planning process, which consists of running a retirement analysis, making sure that our investment strategy is aligned with our withdrawal strategy. Of course, we always want to review and monitor this as economic changes, market environment changes, and then what happens personally in our lives can always change. This is a very important statement here. Because it's a shift from when we're working in our accumulation phase, but creating income from your portfolio is fundamentally different than building wealth, right? It's a transition from, hey, I'm saving, I'm matching, here are my contributions. Now this is what I have. How do I use that to generate income to provide for my living expenses? So greatest risks and concerns. This chart is broken out by, what are your greatest fears about retirement? And it's broken out into different age groups, basically our 50+ workers and then our retirees. You'll see kind of a general theme that our retirement group retirees generally have a plan in place, which which addresses the risks and fears that we have. So we'll look at the dispersion between the two. But most of the common fears that we have, number one out there, by experience, I can attest to this one. It's outliving my savings and investments. We also look at Social Security. Will it be reduced and cease to exist in the future? Declining health that requires long-term care, possible long-term care costs, or losing my independence. We look at cognitive decline, dementia, and Alzheimer's diseases. Of course, when we're, our 50s and healthy, that may not be on the forefront of our minds, but as we start to age, it's more of a topic that we think about. Not being able to meet the basic financial needs of my family. Of course, when you're retired, you have that plan. We're acting on that plan, and helps give us a little more of a predictability, of our income that we're looking at on a yearly basis. Lack of access to adequate or affordable health care. Feeling isolated and alone. We look at the differences of finding meaningful ways to spend time and staying involved. Lack of affordable housing, and I don't have any retirement fears. Being laid off, not being able to retire on my own terms. And obviously that one definitely is geared towards, our workers that are still engaged, in the workforce. So risks in retirement, longevity, this plays into, am I going to outlive my savings? As an example, for an average couple that's age 65, there's a 49% chance that one of them will live to age 90, a 20% chance one will live to 95, and a 4% chance that one of them will live to age 100. Inflation is another big topic there. As an example, a 3% inflation rate will reduce the purchasing power of $50,000 down to just under $24,000 in approximately 25 years. So if we're, 55 or 60 years, by the time that we're, in our 80s, late 70s, early 80s, that, we're looking at a significant decline in that purchasing power. Other risk is market performance and sequence of returns. If we have low or negative returns, especially early in retirement, then, this can be detrimental to our portfolio. The impact of that is, hey, we're in a declining market and we need to, provide for living expenses on it. I mean, ultimately, we're impacting the compounding effect of our returns over the longevity of retirement. And, volatility, again, that's having to withdraw, income, when markets are down. I mean, that does put a significant strain on our investments. The other big one there, healthcare. Healthcare costs are rising faster than the average of inflation. Recent study estimates that, a couple age 65 will spend approximately $230,000 in retirement to cover healthcare, and that's not including, nursing or home expenses. Having, and I don't want to make you sick of it, but I will say this quite a bit, but it places the importance of having a plan. It helps address those risks that we face during retirement. So why cash flow planning and having a retirement income plan? It will help you. We plan for and minimize risks that all retirees must face. I mean, that's the healthcare, that's inflation, that's market volatility. We make informed choices about funding your retirement. How do we, match our investment strategy and our withdrawal strategy, together? We help ensure that we have a predictable income. We want you to know where our funding is going to come from for the next 1, 2, 3, 5 and longer time periods. Determining a sustainable withdrawal rate and appropriate withdrawal strategy to help ensure your money lasts your lifetime. We're gonna address that more in detail about the withdrawal rate, but it is a very important factor into determining, am I going to outlive my investments and savings? Monitoring your plan and adjust to stay on track. As much as I wish I had a crystal ball, I don't. But we want to have a plan that maintains flexibility, that we can, prepare for things in the future that we're uncertain of, but we can prepare for different scenarios in there. Historical averages. We use that to help forecast, our future needs. It's no guarantee of what's going to happen, but it's a pretty good indicator. There is no such thing as an average retirement. I mean, as individuals, and families, we're way too unique to have something that's considered average. We have a four-step approach. We customize, your goals, which includes, insured, income for essential expenses, to cover your needs. And then we want to make sure that we offer flexibility to help you adapt to times when your life or your financial situation is not average. Again, that gets back to, we're not very good at predicting the future, but we want to be prepared for the risks that we know that are out there. From a visual standpoint, this is retirement analysis, investment strategy, withdrawal strategy, and monitoring and reviewing. It's not like you have a plan, you have a strategy, we implement it, and then that's it. Life changes, and we have curveballs. The market environment changes, and we want to make sure that we're adaptive to the environment that we're in. So making sure, step one, you want to analyze your retirement needs, right? So we want to prioritize life goals and set realistic expectations on financially achieving them. So how much income will you need each year? Income needs will change over time. As many of you may be familiar with, the term of go-go years, slow-go years, and no-go years. As we age during the retirement process, our spending profile tends to change with that, because we're not spring chickens, in our 80s and 90s, and we're not out running around. We're not consuming our entertainment. Our spending profile changes quite a bit there. So having realistic, estimated expenses is imperative when it comes to planning and having a financial plan. Basically, we have our essential needs and expenses. We have discretionary expenses, which is our wants. Then we have the unexpected expenses, or, the what if scenarios, or, wealth transfer goals, more of a legacy component in there as well. So from an expenditures by age, again, to see the changes that we have, you can see that, from the different age group segments here, there is a decline in the different, categories of expenses, except for one. Of course, entertainment, food, alcohol, housing, transportation, all others, we see a declining. Where we don't see a declining is in our healthcare. Again, that's, our healthcare costs are raising at a higher level than inflation, and we've got to be able to meet those demands and plan for them in our strategies. So Social Security, sources of retirement income. A lot of us, Social Security is a big one, and also one that we go to immediately. Social Security replaces 90% of income for theoretically less than 1% of the population. For U.S. median income, it replaces approximately 40%. And at a maximum covered earnings, it's 27% of salary replacement. I mean, Social Security was never meant to be an income replacement, but a little bit of more of a supplemental of income into that. So how do we fill in the gap between, Social Security and our what our expenses, our lifestyle demands? One way is pensions. Among private sector workers, though, only 11% are covered by a pension. I mean, that number has declined dramatically, from the 80s and 90s to where we are today. But typically, if it's in the form of a fixed annuity, depending on age, service, and Social Security benefit there. As an example, 1.6% times years of service times salary minus your Social Security offset will give you a pension benefit. Typically it's a career employee, and replaces approximately 50% of salary at the age of 60. The other vehicles that we use is our savings investments. That's our 401ks, our IRAs, our thrift savings plans, and our other brokerage accounts or investment accounts that we may own. We use that to fill in the gap. So how long will my portfolio last? If we look under the metrics of, hey, we averaged a investment return of 5%, inflation was 2%, so that gives us a real rate of return of 3%. Under that type of scenario, a 4% withdrawal rate, provides us, over 40 years of income. Looking at this, a 4% withdrawal rate is safe for a 60-year-old. You could, live to 100 without running out of money. A 5% withdrawal rate is safe for a 70-year-old. A 6% withdrawal rate is, safe for an 80-year-old, and an 8% withdrawal rate is safe for a 90-year-old. Kind of as we get older. What if inflation is higher than 2%? This is a hot topic right now, especially with the impact that we're feeling of inflation right now. When inflation is higher, interest rates will be higher. And in general, investment returns will be higher because they were measured in inflated dollars. If we assume the same real rate of return, the 3%, 3%, results don't change. The shape of the curve changes. We call that the monetary illusion here, but how many years the portfolio will last is identical in here. Again, the 4% withdrawal rate is right there at the same longevity as before, with a 2% inflation rate, but keeping the 3% real rate of return there. So when it comes to investment strategy, there's 5 basic strategy elements here. We have annuities, which are fixed, indexed, and variable. They help provide and have a more predictable, income that comes in. Bond ladders, that's, spacing out fixed income allocation based off of duration. You have your short end of the curve, your 1 to 3 years, or 5 years. You have, 5 to 10 is your intermediate, and then, further out is your long term. So we space out, our bond ladders based off of the duration. Income-oriented investments. This is your dividend-paying stocks, preferred stocks, or your MLPs, your master limited partnerships that provide, equity, potential equity, appreciation, but also kick off, dividend income as well. Fixed asset allocation. This is your modern portfolio theory. Which is you rebalance your allocations to a fixed percentage. Then we have dynamic asset allocation. These are percentages that are reallocated or rebalanced, to reflect the current market environment and the returns that are given. So when we establish withdrawal strategy, these are more kind of possible income strategies to explore. The income-only strategy is very popular and easy to understand. You cannot run out of money if you never have to sell any of your investments. If dividends and interest from the investment portfolio, along with Social Security are enough, you can't run out. We also look at systematic withdrawals. This is taking a pro rata withdrawal from a well-balanced portfolio. This can also consist of, income and taking part of appreciation as income to fund our expenses. We also look at the bucket approach. This is creating specific portfolios that are dedicated to more of our short-term or immediate needs, our intermediate, needs, and then our longer-term needs. So we got 3 parts: short, medium, and longer term. There are many withdrawal strategies, to consider. Some provide more flexibility than others. Again, this emphasizes, the need to run a financial plan that is unique to your situation, to your goals. Again, because there is no average retirement. So if we look at the income only strategy, just under the scenario, hey, we've got $1.5 million in savings, and we need $60,000 a year in income. So what does that makeup look like? If we have Social Security that provides us an income of $2,000 a month or $24,000 a year, we can also space out and have a bond ladder, and have approximately $750,000 invested there. If that averages a 2% annual yield, that gives us $15,000 a year. Then we have exposure to our dividends, our equities, and our dividend stocks. Having $750,000 there invested with a 3% annual yield will provide $22,500 a year. So if we put all that together, that provides us the $60,000 a year in income, and this is all income producing assets here. This is I'm gonna skip through this, but this is basically this is variable based on the times, right? And with the different rates that we have out there with starting with the federal interest rate. But this is just an example of what different investment vehicles and the income produced from those. Bond ladders, again, are short-term, mid-term, long-term, from corporate bonds to mortgage bonds, foreign bonds. This is just kind of a range in which income is provided. Preferred stocks, royalty trust, dividend stocks is, it has a degree of variability in there as well. And then here's our 10-year treasury. Of course, these numbers were picked from a little bit earlier this year, but it is variable based off of the current conditions. This is not a Bogart wealth investment model. This is simply showing, the S&P 500 index since 2000, and the dividends and paid. There are ups and downs in the market value. There are ups and downs in the dividend payouts. The point is the dividend stream is much more stable than the index value. The market value has dropped by 50%, from 2000, 2003, and again, 2008 and 2009. You can see that the dividend payouts took a hit, in 2008, 2009, but it was much smaller than the market value, value over here. Again, from another, strategy, we look at systematic withdrawals. Again, same scenario, $1.5 million in current savings. We need $60,000 a year in income. Again, Social Security provides us $24,000 a year, but now we have a balanced approach. We're in equities and fixed income, and we more focus on our withdrawal rate. If we have a $36,000 a year, that's essentially just under a 2.5% withdrawal rate, which we know that, based off the chart that we looked at earlier, that sub 4% withdrawal rate increases the lifespan of our portfolio by quite a bit. So asset allocation, and the basics here. What I want to point out here, is kind of the sweet spot for retirement, between fixed income and equities here, that we can see that, standard deviation or the risk, when it comes with a 100% bond portfolio, it has the same amount of risk, but a lower amount of return versus having a 50-50 or a 60% stock allocation here. There's no more volatility than you would expect from having the 100% bonds, but with a higher expected return. The average inflation over this time period is 3.5%. So an average return of 6.5% would mean would meet the return requirements of our earlier, how long would our portfolio last? Take a look at the bucket approach, and same scenario, $1.5 million in savings, $60,000 a year income need. If we look at that in allocation, from a bucket, more of our short term, outlook and how do we fund our expenses. Let's say we have $300,000. That's 5 years worth of income. How that's invested at a lower risk, which cash equivalents, money markets, high grade bonds, CDs in there. We have a bucket 2, which is kind of our intermediate phase. We have an allocation of $400,000. Any excess income generated from this bucket can be redistributed to bucket 1. Kind of a sample of investments in here would be bonds and some stock. Then we get into bucket 3 and our allocation of $800,000 here. Knowing that these funds are set aside to be used longer periods of time in the future, we could have slightly higher risks associated with this to maximize our return rates. Again, any excess that's income that's generated from this can be redistributed, to, bucket one or bucket two. Sample investments here is more stock, that's more built for longer term returns. So choices of distributions, right? So which accounts to distribute from first? Typically, we look at non-qualified, qualified, and then Roth accounts. Non-qualified, or think of it as your, checking accounts, brokerage accounts. Qualified is your IRA or retirement accounts, and then you have your Roth. This is a good rule, but it's not always optimal. Again, this is, how to and where to pull from is a essential element that is addressed in having that financial plan and preparation for retirement. We get into, managing required minimum distributions. RMDs start at age 73 or 75 if you were born after 1960. RMDs force you to withdraw a certain percentage each year. That percentage increases with age, and you can withdraw more than what's required if you want to or if you need to. If you withdraw less than the RMD, then we face substantial tax penalties from the IRS. So it's a mandatory amount that we have to take on a yearly basis. We pre-plan, either by spending or converting to Roth IRAs. Ultimately, the objective there is to lessen the tax burden in the future by paying taxes and converting those assets now. This is the different types of income and the taxability of it. Everything that we do, I think is more unique to Bogart Wealth as well, is there's always a tax efficiency component when it comes to a plan, when it comes to investment strategy, when it comes to a withdrawal strategy, and a legacy component in there as well. Considerations for minimizing tax liabilities is we want to hold assets for generating interest income in qualified accounts. That's kind of deferring our accounts there because interest income is taxed as ordinary income. Hold assets generating dividends or capital gains in non-qualified accounts because now we get subject to capital gains rates. We use distributions from different account types and different assets. That's good when we're building. We want to have flexibility to help minimize tax liabilities, and we also want to withdraw qualified assets before required to reduce future tax bills, which is an objective of the Roth conversions, which is addressed separately within the planning process. I also want to focus on, maximizing lifetime after-tax income instead of minimizing, the current tax bill. Over here, this is just the taxability one that I question that I come across quite a bit is Social Security. Depending, it's based off your income levels, but typically 85% of it is taxed as ordinary income. The point here to make is the liquidation of investment of principal. Our principal is always after-tax money, so it's not subject to taxation in there. And of course, Roth IRAs, it's tax-deferred growth, and it's also tax-free distributions. No tax there. This is why that's important. We're breaking down the ordinary income tax rates versus capital gains rates. You can see that capital gains rates are lower than our ordinary income rates. So review and monitor. A very, very important component here. As we review, you will be ahead of plan, or you will be high or be behind in your plan. We'll determine why and make needed adjustments. What does that look like? We look at assets. Are our assets higher or lower than projected? Income. Was our income estimated correctly? Did you receive unexpected cash inflows? Spending. Was our spending what you anticipated? Did we spend more? Did we spend less? From a portfolio perspective, was our return higher or lower than estimated? Do we need to rebalance it? Has our risk tolerance changed? So we look at the allocation constantly. Withdrawal rate. Does our actual withdrawal rate fall in a level of success that you are comfortable with? Again, that gets back to, how long will our portfolio last based off of my withdrawal rate? Inflation. Do we need a spending increase, because of it? We also look at retirement goals and expectations. Has that changed? And how do we plan for it if they have? So when we're using a retirement optimizer, in the planning process here, we're starting with a reasonable initial withdrawal rate. We're building a foundation for our essential expenses, for my needs, my basic living needs. We want to make sure that those are secured first. We want to have a withdrawal strategy for our discretionary portfolio. It's more of our wants. We want to use diversified portfolio that's consistent with your risk tolerance. We want to make sure that's aligned, right? We can't expect certain amount of rates of return if we don't have the risk tolerance. But it also comes back to the plan is, can we afford to take, certain amount of risks? The plan helps answer those questions. We want to implement, spending and withdrawal strategies. Making sure those essential expenses, will be covered, for the lifetime, or the longevity of retirement. And ultimately, we want to increase the probability for having a successful retirement. So when we make adjustments, to help us stay on course, if the return on your portfolio was positive, maybe we increase your income by inflation, with a cap. But if your portfolio return was negative, income for the upcoming year, we won't increase it there. We also look at the withdrawal strategies in terms of income from interest and dividends are collected first. Withdrawal from the portfolio in the following order. So we have asset classes with positive returns. We want to withdraw from there. So we want to begin with equities, and then we want to begin with fixed incomes. We want to look at our cash holdings. Then we would want to pull from our assets with negative returns. This is last in line because we want to pull from gains, not from losses, because that impacts our compounding returns over time. But in that environment, we want to begin with fixed income and then our equities. You need to have a plan. I said it before, and I want to emphasize it again. The plan takes the what ifs, the scenarios that we have in our head, it puts it down on paper, says, hey, this is where we're at, this is what we want to achieve, and then how do we have an investment strategy and a withdrawal strategy, to fill in there to make sure that we have a successful retirement. When it comes to selecting or working with an advisor, you want to make sure that we're qualified and experienced. Right off the bat, you want to work with a certified financial planner. You want someone that knows your retirement plan, that is familiar with the IRS rules and the tax liabilities, and that also has navigated, multiple business cycles and has experience with managing portfolios. You want openness, that we discuss various strategies. We provide, financial planning based on your needs and risk tolerance. And then, provides regular portfolio performance and reporting. Do we need to make changes? And then understandable, speaks in a way that you can understand there. I highly encourage you that if you have not had or you're on the fence about it, or you're planning for retirement, or you need another opinion to it, that you seek a one-on-one, financial strategy, session, preferably with Bogart Wealth. Again, this is just kind of our offices. This is our contact information. I want to thank you for joining today. and our look on cash flow and withdrawal strategies. As you can see, that it's very complex and just drives home the need for a financial plan. Again, thank you for joining today. I hope everyone has a wonderful rest of your day, and hopefully we'll talk to you soon. Thank you.